Hello, everyone. Welcome to Conversations with the Fed, our quarterly lecture series at the Minneapolis Fed. Today, our topic is urgent problems facing communities during COVID-19, and we'll be hearing from members of our Community Development and Engagement Department. Thank you so much for being with us. We have an hour of time scheduled today. Our presentation should only take around 45 minutes. We're hopeful that we'll have time for about 15 minutes of Q&A at the end of the presentation. If you do have questions during the course of the presentation, please use the Q&A button that's located at the bottom of your Zoom screen. Also, when you leave our presentation, you'll be presented with a survey in your browser that will pop up, and we'd love to get your feedback at the end of the presentation. Thanks again for joining us, and I'm going to turn it over to Alene Tchourumoff.
Well, thanks so much, Carmi. Hello, everyone, and welcome to today's edition of Conversations with the Fed. My name is Alene Tchourumoff, and I'm Senior Vice President of Community Development and the Center for Indian Country Development at the Minneapolis Fed. I'm joined today by my colleagues, Roberta Downing, she's the Assistant Vice President of Policy Development, Ryan Nunn, the Assistant Vice President of Applied Research, and Casey Lozar, Vice President and Director of the Center for Indian Country Development. We're all excited to be here with you today. If we move to the next slide, here is our normal disclaimer. What you are about to hear represent the views, our individual views, and not necessarily the views of the Minneapolis Fed or the Federal Reserve Bank system. It's always fun to start a presentation that way, but we need to just get that out of the way. So if we move to the next slide, we can talk a little bit about what we're going to do today. We're going to talk about an introduction of community development and talk about what we've been up to over the last several months, especially in the pandemic. If this is your first time tuning into a conversation with the Fed, welcome. And if you're a regular listener, welcome back. I often think about community development as the on-ramp for members of the community to the Federal Reserve. But did you know that there's a historical reason for that? If we move to the next slide. In the late 1970s, Congress created the Community Reinvestment Act, and that was a specific act of Congress to remedy the action of redlining. CRA was designed to ensure equitable access to credit for all individuals and neighborhoods by making sure banks serve the communities where they do business. So in order to do that, we really need to have an understanding of what the credit needs are in those communities, especially with low and moderate income members of those communities. So each one of the 12 reserve banks has a community development function across the country. If we move to the next slide, community development's role in Minneapolis, as well as across the country, has really shifted from the late 1970s. We're really focused on that credit and credit access for low and moderate income members of community to being more closely tied to the Fed's dual mandate. So if you remember, if you're a longtime listener or a Fed watcher, we think about the Fed's dual mandate as maximum employment and stable prices. Community development's role is now more closely tied to the maximum employment side of our dual mandate, and that allows us to look at policies that impact low and moderate income members of our communities beyond credit access. So our team here in Minneapolis is constructed and organized in a way that we can bring up applied research and policy discussions and solutions to our communities. So today, we're going to talk about what we've been working on during COVID. And I'm sure many of you know that the Federal Reserve has been called upon to serve in an emergency lending capacity. And that's even more important for us to know what's going on in our communities so that as the system and as our colleagues across the system are crafting those solutions and those emergency lending programs and working closely with US Treasury and Congress, that we're responsive to what the community's needs are. So if we move to the next slide, I'm going to give you a little bit of an overview of what we're going to talk about. We'll talk a bit about childcare. We know it's been hit really hard during COVID, but we also know that it's a critical part of our economy, especially in terms of getting parents back to work. We talk about housing and mortgages. The mortgages were central to the crisis in 2008. And in some ways, Congress and the federal government wanted to avoid the same crisis this time around. So there's been some very specific actions by Congress. But that's also changing some elements of consumer credit. So we'll talk a little bit about what we're monitoring in terms of housing and mortgages within the 9th District in particular. If we move on to the next slide, I want to call out that the Minneapolis Fed is also the home to the Center for Indian Country Development. It's a national center. It's a national resource within the Federal Reserve System. So our community development work really kind of focuses on that 9th district footprint, but the CICD has the opportunity to work with tribes, tribal nations, tribal governments, and communities across the country. So that's been, I think, even more important in this time of crisis as we have a research institute to understand the impacts of COVID on tribes and their communities. I also want to call out 2 other special initiatives as examples of how we engage in research and how we think about policy in the 9th district. So if we move on to the next slide, in addition to responding to COVID and seeing the deep disparities of who has been impacted by the virus, we in Minneapolis, I think, have also been deeply affected by the death of George Floyd and so many others before him, that many of us were thinking about the way in which we could address the situation that we see in our communities and try to contribute constructively to the conversation. And so we launched just last week a new series called Racism in the Economy. And the series is designed to explore the way in which racism manifests in our society and our economy. About once a month, so we'll have the launch on October 7th, but then after that, about once a month, we'll explore challenges in employment, education, housing, financial services, criminal justice, health, and actually as well as racism in the economics profession itself. So we're not only looking at exploring the context and understanding how structural racism manifests, we also want to look at exploring actions and solutions. So the policy sessions around employment, around education will really be designed to bring forward ideas that can kind of tackle some of the components of structural racism in each of those areas. If we move on to the next slide, this next slide really kind of talks about the research that we've conducted on educational disparities in Minnesota. I'm sure many of you may or may not know that we have some of the worst educational disparities in terms of outcomes for kids of color and low-income white children across the state. Earlier this year, President Kashkari and former Supreme Court Justice Alan Page proposed an amendment to Minnesota's Constitution that would provide a fundamental right to quality public education. And so this is something that we're also really closely working on. And it's an example of how we think about doing our research in education and having an understanding of what's happening in our education system across the state of Minnesota, for example, and then bringing a potential solution or a way of thinking about a solution to the community, to lawmakers and others. So that's a quick highlight and overview of what's to come in the next hour. Really excited to hear from all of you, and I hope that you think of questions as we go through the presentations that my colleagues are about to do. So I'm going to now turn it over to my colleague, Roberta Downing.
Hi, everyone. Thank you, Alene. So I'm going to start off by talking about early childhood education programs generally, and then we'll discuss some of the more recent challenges that the COVID-19 pandemic has created for childcare providers and families. So for almost 20 years, the Minneapolis Fed has been working on the issue of early childhood development. This work is led by Rob Grunewald, along with Ben Horowitz and other staff in the Community Development Department. It's important to recognize that childcare has a 2-generation impact on workforce development in the economy. It allows parents to enter the workforce and be productive at their jobs, knowing that their kids are being taken care of in a safe place while they're at work. Without childcare, many parents will stay out of the workforce altogether or have to reduce their work hours. And if childcare arrangements are unreliable, it can reduce workforce productivity and increase employee turnover, which then increases costs for businesses and for families. A number of studies reinforce these facts. A recent survey of parents with children under the age of 5 in Louisiana showed that over 40% of respondents had missed work during the previous 3 months because of childcare issues. Another report by Cornell University suggests that parent absenteeism, productivity reductions, and turnover due to childcare breakdowns cost U.S. businesses more than $3 billion annually. Lastly, a paper published by the U.S. Chamber of Commerce, their Center for Education and Workforce, found that over 70% of non-working, low-income adults with children under age 5 cite taking care of the family as a reason why they're not in the workforce. Next slide, please. Research shows that investments in high-quality early childhood development programs are both cost-effective and have a high return on investment. So for example, on this slide are 4 key long-term studies that demonstrated that early childhood interventions can have a positive impact on young children from disadvantaged environments that last well into adulthood. The Perry Preschool study was started back in the 1960s and followed children who participated in the study longitudinally throughout their lives. That study found that for every $1 that was invested in an early childhood development program yielded up to a $16 return on investment. The Abecedarian Educational Childcare Study is another study that started back in the 1970s where participants were tracked throughout their lives. That study showed that for every $1 invested in early childhood development yielded up to a $7 return on investment. And like the Perry Preschool study, the Chicago Child Parent Centers provided preschool for 3- and 4-year-old children, and a study of this model showed benefits similar to the Perry Preschool program. Other studies have provided home visiting programs where nurses visit high-risk families in their homes, and those kinds of programs have shown roughly a $5 return on investment to every $1 spent on the program. So while children and families benefit from these investments, the majority of the benefits accrue to the rest of society, mostly in the form of children performing better in school and earning more in the workforce, reduced overall criminal justice costs, and reduced special education costs. Next slide, please. So anyone who's had to, has looked for childcare knows that there are a lot of barriers to childcare in general, and then also now during the COVID pandemic. The first is being able to identify high quality programs. And the challenge here is that high quality programs are expensive, and it's difficult to support these programs because it requires higher costs. And as many of us also know personally, childcare is expensive. The national average for infant childcare is $11,000 per year per child at a center, and $8,700 per year per child in a family care setting. In some regions, the costs are much higher than that, and public subsidies may often fall short of meeting the total need and cost of childcare. Region matters a lot with childcare, where in rural areas, there are fewer childcare slots per young child. Next slide, please. The pandemic has created a number of financial challenges for childcare providers. One is that demand for childcare dropped sharply last spring. Other issues are that now providers have needed to modify their practices in order to address COVID safety and health-related concerns. So for example, child drop-off and pickup practices have changed, with staff having to perform daily health checks on children. Childcare centers have also had to hire substitute teachers or close classrooms due to COVID-19 exposure. Providers have also needed to purchase more basic cleaning supplies and personal protective equipment. And then many states have imposed a 10-person group limit in accordance with Centers for Disease Control and state guidelines, which means that providers have to limit the number of adults and children in a classroom to 10. What all of that means is that providers are having to serve fewer children, but still paying their regular fixed costs of running a childcare centers. We know that not all families are returning to childcare during the pandemic, and that without children, childcare centers won't get paid. The bottom line is that childcare centers are operating without the revenue needed to sustain their business. A recent study by the National Association for the Education of Young Children indicated that 2 in 5 childcare programs are likely to close without intervention. Without access to reliable childcare, the economic recovery for working parents will be challenged. It's not easy to start a childcare center from scratch if many of them close. There are a lot of steep upfront costs, licensing requirements, access to credit needed, and other issues. During the pandemic, reserve banks have been writing about these challenges and highlighting the important role the childcare sector is playing during the pandemic. And policymakers are also grappling with these issues. The CARES Act distributed $3.5 billion to states last spring, and lawmakers in both parties have proposed legislation to fund relief for childcare providers. We'll see what happens with that moving forward. Now I'm going to turn it over to Ryan Nunn, Assistant Vice President for Applied Research and Community Development. Thank you.
Well, thank you, Roberta. So, having just heard about the impacts of COVID-19 on childcare and the childcare sector, I'd like to talk a little more about how borrowers are faring, particularly in the 9th District. So next slide, please. So what we focused on in some recent analysis specifically is the mortgage market, auto loans, and credit cards. And the way we explore these data is to look at delinquency rates. So we define delinquency rates here as being overdue by at least 30 days on a particular debt. And we found a pretty interesting picture. On the one hand, mortgage delinquency rates are up substantially in both the 9th District and the United States as a whole. On the other hand, auto loan and credit card delinquency rates are either stable or actually falling over particularly the early months of the pandemic. Now, there's one caveat that I'll talk a little more later about with respect to the mortgage delinquency rates, and that's that our data count mortgages that are in forbearance programs as delinquent if the borrowers are at least 30 days overdue. So in the analysis that I'm about to show you, we look at various parts of the 9th District, urban, rural, and Indian country areas, and we found pretty consistent trends across places when we did that. The US had a similar pattern to the 9th Federal Reserve District, but the conditions were substantially worse in the United States than in Minnesota, the Dakotas, Montana, and the remainder of our district in the Upper Peninsula of Michigan and part of Wisconsin. Next slide, please. So here I'm going to walk you through some of the analysis that we conducted. So what we did is we started with the baseline period of February 2020, when the pandemic in the United States had not yet struck. And then what we did is look at the cumulative change in percentage points in delinquency rates. On the top left, looking at mortgage delinquency rates, the bottom left looking at credit card delinquency, and then on the right looking at auto loans. And so as I mentioned a moment ago, in the mortgage sector, we see borrowers much more likely to be delinquent on their mortgages over time. So through May, those delinquency rates rose quite sharply. Since then, they've leveled out in data that's not shown in these figures. By contrast, though, credit cards and auto loans show pretty different patterns. We see, either stable or falling rates of delinquency on those forms of debt. So if you look at the teal bars throughout, that's the overall change in delinquency rates for the 9th District. Next slide, please. So as I mentioned a moment ago, there's an important policy piece to this story in the mortgage sector. So forbearance programs that were provided as part of the policy response to COVID-19 have really met with a lot of interest. So borrowers who indicate that they are experiencing financial hardship as a consequence of the pandemic, they're generally able to get up to a year of forbearance in their mortgages. And so in some results that we obtained separately, we see that forbearance participation goes from a negligible level in March of this year all the way up to 12% in June, subsequently falling a bit. And that's looking at a subset of loans that are backed by Ginnie Mae. But what it suggests to me is that forbearance is playing a really important role here. It's allowing borrowers to prioritize other forms of debt, to postpone making payments on their mortgage debt. Now, this is all a picture of what we've seen so far. Of course, we could start to see credit deterioration going forward, and that's really why we're going to continue to monitor conditions, particularly with mortgages in the coming months, because we really don't know precisely what will happen. It'll depend on a couple things. The first is what policymakers elect to do in coming months. We may see additional supports for workers, for the economy as a whole. It also depends on the speed of the labor market recovery. So we've seen just a really unprecedented increase in unemployment rates, followed by a partial but also rapid improvement in unemployment rates. And going forward, it will be extremely important to see just how much more labor market improvement that we can see. So next slide, please. So what I like to do now is to turn to one of the most important policy supports that were provided to workers and to LMI communities during the pandemic as part of the CARES Act. So what we'll talk about is some analysis that we did of the Pandemic Unemployment Compensation Program, which was an addition to unemployment insurance. So unemployment insurance is, of course, a really critical support for both workers and the macroeconomy. So when workers lose their employment, they, of course, it's really large income losses. And unemployment insurance is absolutely key to replacing some of that income loss, helping workers to get through their next job, or in some cases back to their previous employment. I think what's less appreciated is that UI is really important for the economy as a whole. By supporting workers, providing them with funds that they can use to maintain their consumption, we keep the economy in better shape than it would be otherwise. Okay, so PUC, Pandemic Unemployment Compensation, was that added $600 per week that UI recipients received from late March through late July. We conducted some analysis of this program and of UI roles in summer, and what that analysis suggested is that recipients would lose something between 11 to $19 billion per week in the country as a whole when PUC expired. There's a wide range to that because of some uncertainties in the UI data, particularly as state agencies were really hard pressed by the increase in UI roles. So our analysis indicated a few things. First, we saw that UI recipiency was particularly high, disproportionately high for younger workers. Those were some of the folks who were particularly losing employment during the early months of the pandemic. We also saw that certain occupations were harder hit than others, and workers in those occupations were more likely to end up in the unemployment insurance program. Workers in food prep, in production, and personal care particularly affected. Now, I'll show you some of those results in a moment. But first, I would just note that in addition to the PUC expiration that we analyzed in that recent analysis, it's also important to note that workers will soon be exhausting their overall UI benefits as they reach the maximum duration of their UI benefits. So in the next slide, here you can see the occupational breakdown that we did in our analysis. So if you look at the bottom of, you see the blue for of unemployment insurance recipients to their share of the labor force as a whole. So what you see is that for food prep workers, we find them in the UI program at more than 3 times the rate that we find them in the labor force as a whole. And so what that reflects is the fact that particularly early in the pandemic, food prep workers were losing their jobs, were being furloughed at really high rates, that they were affected disproportionately by the virus itself and also the public health measures that were necessary to combat it. So a similar story is true for personal care workers. We're talking here about cosmetologists, barbers, people working in gaming, a whole host of occupations where there's a lot of in-person interaction that's required. By contrast, at the top of the figure, you see workers in occupations that didn't have to work as much in person with customers, occupations in the sciences, business and financial operations, as well as management. Many of the workers in those occupations were able to work remotely and were less affected by the pandemic. So we see pretty similar trends for the United States and the 9th District, but some differences. Health support occupations in the 9th District appeared to be more affected here than elsewhere. So next slide, please. Okay, and here's the picture by age. So what you see in the blue bars are the percent of the labor force that each age group represents. And this is for the 9th district. In the yellow bar, you can see the percent of UI participation represented by that group. So I actually found these results pretty surprising. Younger workers tend to not have the earnings histories that qualify them for regular UI. And so you might expect that they would actually have lower, less than proportionate representation in the UI program. However, we found that younger workers actually were disproportionately represented in UI relative to their numbers in the labor force. And I think that what that reflects is the tendency to be in occupations and in jobs that were especially hard hit by the pandemic. And so I'll just conclude my segment by saying that we think that this sort of analysis is really important for understanding how LMI communities and workers have been affected by COVID-19, but really also for understanding how policymakers can better refine the kinds of programs in UI and elsewhere that have been important for sustaining workers and communities through this crisis. And so with that, I will turn things over to my colleague, Casey Lozar, who is Vice President and Director of the Center for Indian Country Development.
Wonderful. Well, thank you, Ryan. And I just too wanted to introduce or welcome everybody to this afternoon's presentation. We're really excited to have you here and to learn more about the work that we're doing at the Community Development Engagement Office. As Ryan mentioned, my name is Casey Lozar. I'm an enrolled member of the Confederated Salish and Kootenai Tribes, where I have the great opportunity to be the director of the Center for Indian Country Development. And as Alene mentioned, this center is a research and a policy institute that has a footprint that goes beyond the 9th district. And so we work with tribes, all 577 tribes across the country in all 50 states, to really assist in helping them reach their full economic potential. And I want to talk a little bit today about some of the economic impacts that we've been able to uncover during COVID. But before I do that, I think it's important to really set the context of how Indian country has been impacted from a public health perspective. So Native Americans, if you go back to the next slide, Native Americans have experienced the COVID with nearly 3 times more cases, 5.5 times more hospitalizations, and 1.5 times more deaths per capita than white non-Hispanics. So obviously a disproportionate impact in Indian country, and this is due to a number of different factors. A couple that really jump out at me when you think about the directives from public health officials of washing your hands and practicing social distancing. Well, in Indian country, access to clean water is a particular issue, with about 13% of tribal communities not having access to clean water, which is compared to 1% nationally. If you look at practicing social distancing and you think about housing in Indian country, about 16% of households are overcrowded in Indian country, which is about 8 times the national average. So you sort of combine issues with access to clean water and overcrowded homes and couple that with some of the pre-existing health conditions that Native Americans struggle with, as well as sort of underfunded and underprepared health system. The impact on the public health of Indian country has been disproportionately significant in our communities. Now, if we move on to the next slide, I did want to paint a little bit of a picture beyond the public health impacts and really look at some of the economic impacts or some of the economic concerns that we've been tracking during the pandemic. And Indian country and our tribal governments are sovereign nations, and they have formal relationships with the federal government. And as sovereign nations, they've got their own revenue streams that allow them to provide the essential government services that tribal members need. and very different set of revenue streams when you compare it to city, county, and state revenue streams, in the sense that tribal governments have a very limited tax base. They rely on the proceeds and the revenue streams that come from the enterprises that they own, which makes them very different than when you think about the revenue streams coming from state corporations. And also there are some limitations in terms of the type of capital finance tools that are available, particularly thinking about tax-exempt bond financing, which is going to be particularly important as we think about long-term economic recovery. Ryan shared some really good information as it relates to employment and the unemployment issues that we've experienced in low and moderate income communities across the country. Native American employment has also had quite a bit of a roller coaster in terms of the levels of unemployment that we've experienced over the past 6 months. And I'll get into those details in a couple slides. I also, wanted to just note that access to credit in any sort of recession is really key in sort of the length of and the success in recovery for particular communities. And I think the federal government, as Alene shared with our Federal Reserve facilities, really plays a critical role in that recovery. And lastly, when you think about the Center for Indian Country Development as a research institute, one of the things that we're really trying to address is the data deserts that exist in Indian country. With only 1% of the population, oftentimes Native communities are left out of studies or left out of analysis due to small sample size. So our team here at the Center for Indian Country Development and the Community Development Engagement team have really worked hard to generate real-time economic data directly from Indian country. And before I get into that real-time data, if you go to the next slide, I did want to share the story of the uneven impacts due to of unemployment rates in Indian country. And I think it's true that in recessions typically have disproportionate effects on workers of color. It is true for the Great Recession. It's true for the pandemic recession so far. And if you look at this chart here, you can see sort of the different levels of unemployment pre-pandemic. And then you can see between sort of March and April, a significant spike in unemployment rates. Unemployment rates in April for our Native employment jumped to over 25%, so close to 26%, which is about double that of white workers and nearly double that of African American workers. Thankfully, what we did see is a kind of a reduction in those unemployment rates as some of the phasing happened in some of the states in terms of getting the economies back online. We did see some Native employment come back into the labor market, and unemployment rates dipped down to 12.5%, about 13%. And we've been hovering at about 13% over the past few months, which is positive compared to April numbers, but certainly a significant rate of unemployment in our Native communities. And all the information that I just shared, we were able to uncover through publicly available data. But as I mentioned earlier, we really wanted to get some voice from Indian country of really understanding the real-time impacts of some major institutions in our tribal communities. And if you go to the next slide, we began conducting these pulse surveys in Indian country. So far we've done 4 different surveys. And our primary focus has been how are specifically tribal governments faring as it relates to employment and revenue and capital needs, and how are tribal enterprises, those enterprises that are owned by tribal governments, how are they faring? And this slide from May really tells the story of deep and rapid revenue declines for tribally owned enterprises and then tribal governments. Now remember, with a very limited tax base, tribal governments really rely on tribal enterprises to produce revenues. So there's a bit of a yin and yang between the impacts on tribal enterprises and how that may cascade into impacting the revenues available to tribal governments. So we see that about 80% of tribal enterprises early on saw revenue losses of more than 20%. And approximately 40% of those tribal enterprises experienced losses of more than 60%. So revenue declines of 60%. How that impacted tribal governments? Well, a quarter of tribal governments reported that they suffered revenue losses of 100%. So essentially, the faucet of revenue between tribal enterprises and their tribal owners, tribal governments, were shut off. And this was due in large part because of many of the tribal enterprises operate in hospitality and entertainment industries, which were just disproportionately impacted by social distancing measures. In fact, 100% of Indian gaming operations closed in the United States, and they have since started to come back online, but you can see how critical those closures were in the early phases of COVID in Indian country. If you go to the next slide, we wanted to get a sense, knowing how big the impact, economic impact has been in Indian country, we wanted to really better understand directly from tribal leaders what some of the solutions may be to sort of address economic recovery. And so we've hosted a series of meetings with tribal leaders and lenders with larger tribal native portfolios to really get a sense of what is needed. And one of the things that was noted is the need for additional credit as we look at economic recovery over these next few months. And as Alene alluded to, the Federal Reserve initiated emergency lending facilities when the pandemic started. And those facilities have provided a critical backstop, really stabilizing and substantially improving market functioning and enhancing the flow of credit to households, to businesses, to state, local, and now to tribal governments. We identified one of the primary Federal Reserve lending facilities for small businesses across this country were the Main Street Lending Program. And a part of that program, there was a restriction where if you were going to be a participant in seeking and getting credit through the Federal Reserve, you were not allowed to be able to provide capital distributions back to your owner. Well, if you think about the role of tribal enterprises in their providing revenues back to the tribal governments for essential government services, this was a problem. And so we worked very closely with the Board of Governors and closely with the Department of Treasury to create a waiver to allow tribal enterprises to participate in the Main Street program while at the same time doing what they're supposed to do, which is providing capital back to the tribal enterprise. If you move on to the next slide, we wanted to also look at a different part of the key aspects of a tribal economy and really hone in on those tribal small businesses that make up the backbone of tribal economies. And we partnered with the National Center for American Indian Enterprise Development. And we conducted a survey in the middle of July, and we were able to get 400 respondents to complete the survey. And we found that just 18% of those tribal private sector businesses have escaped revenue declines, which means more than 80% have seen revenue declines. And over 50%, as you can see from this chart, of respondents have experienced revenue declines of more than 40%. And 16% of those businesses saw revenue losses of 100%. So no longer seeing any sort of profits. 50% also are expecting the same level of revenue declines in the next 6 months. So the outlook isn't necessarily promising as it relates to revenues for the tribal private sector. But if you go to the next slide, there were some positive news. We saw that in the survey, about 60% of those tribal private businesses reported that they had not laid off or furloughed their workers, which is a particularly high percentage. So I think this is positive, maybe a sign that some federal programs have been working in Indian country for those tribal businesses that could access that. I'm thinking of PPP, which created that relationship and maintained that relationship between employer and employee. There may have been some positive benefits that we see in this chart. But if you do look at those other, the far right of the chart, nearly 20% have seen a complete separation with their workforce. So this is a bit of a tale of two halves as it relates to sort of layoffs and furloughs for tribal private sector businesses. If you go to the next slide, and we really wanted to understand sort of what does the future look like? What is a return to what may be considered normalcy? When might that happen? And two, the outlook is a little bit bleak in Indian country. A return to normalcy, we saw that half of the respondents anticipate a return to whatever normalcy is to be more than 6 months out, and about a quarter expect never to return to their pre-COVID levels. And while I think from a public health perspective, as well as from the economic impact perspective, the future looks a little bit bleak, I do think there's some really positive things that we've seen in Indian country that have really brought our tribal partners and our tribal communities together. And I think if you've heard from my colleagues on the presentation today, that really having those relationships with community is absolutely critical for policymaking. It's critical for us to elevate the voice of community, the experiences of community, to really help shape and inform policymaking at all levels. And we're really excited to be a partner to our low and moderate income communities as they're experiencing the COVID and experiencing what could be in our economic recovery. With that, I will turn it back over to Carmi for some Q&A.
Great, thank you all. We are going to go now to Q&A. If you have questions for any of our presenters, please locate the Q&A button at the bottom of your Zoom window, and you can type your question there. I will also let you know that all of you who are registered for today's event will be receiving a follow-up email from us in a few days that will contain a link to this video recording, as well as a copy of the presentation slides, which are also currently available on our website. And again, if you are leaving us early, please take the time to answer our 3 question survey to give us a little bit of feedback about this event. So first question, Alene, is for you. Can you give us an example of how the Fed interacts with policymakers to affect some of the change that you've been talking about?
Sure, thanks, Carmi. I think there's a couple of ways that we could give a few examples. One, I think, is in early childhood work that Roberta was talking about, and that's something that we've been engaged in for many years, and we have an active several of my colleagues are active with members of the legislature, as well as actually with practitioners who are providers of and running daycare centers. So being able to kind of implement a policy at the state level, but then also being on the ground at that implementer level, I think is really important. Another example is some of the work that we're doing now in housing. With the city of Minneapolis. We're working with the city over the next 10 years to help them kind of review and analyze the impacts of the 2040 comprehensive plan and the land use changes that were part of that. So there's a number of ways that we can kind of engage in policy. And I say that I use the word policy kind of loosely in the way that there's federal, state, local, tribal, as well as administrative policy. There's many organizations like the one that I used to work for here in the Twin Cities metropolitan area, or other state agencies, federal agencies that have authority that doesn't necessarily require an act of Congress to change administrative or internal policies. And so we think about that as well.
The next question is for Ryan. Ryan, going forward, what unemployment insurance policies do we need to support workers?
It's a great question and an important one, I think. There are a number of things I could talk about, but I guess I'll focus on a couple. I think that what the pandemic has exposed is really the need to look to workers who aren't eligible traditionally for unemployment insurance, people who don't have the full-time work history that's necessary for them to claim regular benefits. There are a lot of workers who have benefited from pandemic unemployment assistance, which was added in March by Congress, and the UI system has been able to reach many of these folks who aren't traditionally eligible. But I think we'll need to figure out going forward how we can do this in the UI system on a more sustained basis. And then the other thing I would point to is really the importance of having a system that responds well to uncertainty. So we really don't know how quickly the labor market and the economy will recover. We don't know exactly what will happen with the pandemic. And I think that a UI system that had automatic triggers in economic data, that used the most recent high quality economic data to scale up and scale down as necessary would be a real help, both for workers and for providing the right amount of fiscal stimulus to support the economic recovery.
Great, thank you. Casey, a question for you. Given the significant impact of COVID-19 on tribal communities, are there any positive things that have surfaced as Indian country grapples with economic recovery?
Well, that's a really good question, Carmi, and the answer is yes. I think when we look back over the last 6 months, there's been some really phenomenal things that have happened in terms of sort of collaboration and integration among tribes at a regional level, at a sort of state-based level, and then across the country, where a number of different national nonprofits have really come together to really talk about what are some of the really specific things that are happening economically, public health-wise, and what are some of the solutions. And I think there has been sort of a new and expanded set of coalition building that's happened in Indian country that's really had a positive impact in really helping to tell the story about how Indian country is faring with the pandemic. With just 1% of the population, it is really often, we sometimes hear Indian country being sort of asterisk nation without a voice. And I think these Native organizations and in partnership with the Center for Indian Country Development has done a good job of really elevating that. I would mention maybe one other thing as it relates to some resources that have come to Indian country. National and regional nonprofits have really stepped up to the plate. I'm thinking of some organizations like Indian Collective and the First Nations Development Institute and the National Congress of American Indians have really provided direct resources to help Native communities who are struggling, to really prop up some of the small businesses, Native ranchers and farmers, providing IT equipment for Native kindergartners through college students to be able to actually access education as they're kind of moved on to a virtual experience. So there have been some amazing things that have happened from nonprofits around the country and from Native organizations to really help sort of tell the story of how Indian country is dealing with COVID.
Great, thank you. And another question for Ryan. Ryan, do you have data on mortgage delinquency in specific local communities?
We do. We did not put that into the analysis that I presented and that we've already published, but I think there is a lot to gain from taking a look through our region at the communities that are experiencing the most hardship. And we can see that. And in fact, we plan in the coming weeks to publish exactly this, a tool that would help us to see where the distress is most acute.
Thanks. There is a question in the chat as well about childcare demand. I'm not sure if this will be for Ryan or for Roberta, but childcare demand has gone down during the pandemic, and that's been noted as negative for the childcare industry. But has there been any research into the positive impact of parents spending more time with their children?
I think that's a really interesting question, but have not seen any evidence to be able to answer that question.
The only thing I would add is just that you might expect the effects to be pretty different during a pandemic when folks are trying to balance, their work responsibilities, their childcare responsibilities. I wouldn't necessarily expect the effects on kids to be as positive as you might get in other situations.
And a question about the constitutional amendment. One of our attendees has read about our work on education and the proposed amendment to the Minnesota Constitution. Alene, do you want to say a little bit more about that?
Sure, I can talk a little bit about kind of the status of it. I think it just in the last legislative session here in Minnesota, both the House and the Senate introduced language to amend the Constitution, the language that Justice Page and President Kashkari had proposed. And we've had the opportunity to have a number of conversations in communities across the state and with our tribal nations as well, to talk about what they view and the priorities that they see in changing the Constitution to support quality education, quality public education for every kid in Minnesota. So that outreach and engagement continues. Even though we are in the middle of a pandemic, we try to do it virtually, but we know that the timeline has shifted because a constitutional amendment has to be first approved by the legislature in the state of Minnesota, first approved by the legislature, and then would go on the ballot in a statewide ballot. And so we have a statewide election coming up here in November, or national election, but there's statewide folks on the ballot as well. And the next time that happens is in 2022. So we have a little bit of time to continue to talk with folks around the country, around the state, about the impacts of what the amendment would do to try to improve accountability and outcomes. I think the other thing I would just mention is that there is also an external group called Our Children that's working on their own engagement and outreach on the amendment.
Thank you. We have reached the end of the questions that have been posed in our chat. So thank you to all of us for joining today. If you joined a little bit late, you will be receiving a follow-up email that includes a full recording of today's presentation, as well as a copy of our slides and a link to some additional resources that you may be interested in. As you are departing us today, please fill out our survey form to give us some feedback about this event and how we can better perform for you in the future. Thanks so much for joining us. Bye-bye, everyone.